Let me ask you one very important question. If one thing goes wrong, should all your money suffer? The answer to this question should be definitely not. Many investors make this mistake that they put all their money in one fund or one category of fund. Today, I'll explain you why this is risky and what you should do instead of this. Firstly, let us understand what is this mistake. Some people invest only in one mutual fund or only in equity mutual funds or only in one type like small cap or sectorial funds. They feel this fund is doing well, so let me put everything here. This looks very simple, but it is very risky. Now let us first understand why is this risky. No investment performs well all the time. If one fund underperforms, faces market trouble, or that category goes through a bad phase, then your entire portfolio suffers. There is no backup, there is no balance. Now let us have a look at simple real life example. Think of your money like eggs. If you keep all eggs in one basket and the basket falls, all eggs break. But if you keep eggs in different baskets, even if one falls, you don't lose everything. Investing works the same way. Now, let us have a look at what good investing looks like. Good investing means first, spreading the money across different asset classes properly. Second, not depending only on one fund or on one category of fund. And third, keeping the balance as per the decided asset allocation in your portfolio. This is called as diversification. Rule number one of investing is asset allocation. Asset allocation is nothing but the distribution of your money into various asset classes such as equity, debt, commodities like gold, silver, and many more. It is normally expressed in percentage. Now, the factors on which this asset allocation depends are first, your goal based on what you are investing for, such as for your child education, child marriage, or retirement, or even wealth creation. We have to decide how much should be invested in debt, equity, and commodities. There is special category of mutual fund for your specific financial goals, which are called as solution oriented schemes, which includes first, children give funds for your child education as well as for your child marriage. The second is the retirement schemes, which are specially designed for your retirement. Now, the second factor on which the asset allocation depends is your time period. Broadly speaking, your financial goals are divided into three categories based on the time period. First, short-term goals. Typically, the goals which are less than 3 years are called as short-term financial goals. In short term, the equity may become more volatile asset class and hence should be avoided for the short-term goals. Instead, you should always prefer debt mutual funds for your short-term goals, which may be included like liquid funds or short-term funds. The second is the medium term goals. Typically, the goals which are in the range of 5 to 10 years come under this category. The typical asset allocation suggested here would be the mix of equity, debt, and commodity. The proportion of each category depends upon the your risk taking ability. If you are a risk taking investor, then the equity proportion in the asset allocation should be more, and vice versa for the conservative investors. Now, the third uh, in the long term goals is goals which are 10-year plus away are called as a long term goals. Here you should go for maximum equity allocation in your asset allocation. Here also the equity exposure depends on your risk taking ability. Typically the reason for the equity allocation is equity has delivered good returns in the long term. Now, the third factor on which the asset allocation depends is your comfort with risk. This is nothing but how well you can handle ups and downs without panic, decides how much risk you should take. So, from this, you can clearly understand that asset allocation protects you in the bad times of the equity market because it includes debt and commodity portion in the asset allocation and gives growth because of equity in the good times of the market. Now let us have a look at what you should do instead. The first point, use more than one fund. It has been typically observed that investors often invest all their money in one fund which has delivered highest returns and often get trapped. So you should always use more than one fund while investing and must always have an financial advisor for taking such crucial financial decisions. The second point is use different categories. Another observation about investors is that they typically invest in more than one funds but of same category which is delivering good returns. While they are investing, after few days that category starts to underperform and their entire portfolio also underperforms. In order to avoid this mistake, you should always invest your money in different categories of funds so that your portfolio will not be affected by the underperformance of any one category of mutual funds. And the third most important point is balance of equity and debt. Once your financial advisor has decided your equity and debt allocation in your portfolio, you should always balance that proportion so that you will get good returns in the long term. So you don't need too many funds in your portfolio. You just need the right mix. Now, strong closing message. Remember, high returns are important, but safety and balance are more important. Spreading your money wisely reduces the stress and improves long term results. If this video helped you, please like, share, and subscribe to our channel. In the next episode, I'll explain another common mistake that many investors don't even realize they are making.